Debt ceiling's
Yeah,
back, so that's always fun. We also have infrastructure, lots of question marks. In D.C., you have potentially peak growth, potentially peak earnings, and inflation numbers really creeping up, particularly in the earnings reports. Do we see 1% on the 10-year or 1.5% on the 10-year first? How does that play out?
well, we at Pimco aren't as interested as much in point forecasts for yields as we are in prudent portfolio construction. There is a place for fixed income in a portfolio or in a set of investments that has risky assets. So we at Pimco, for example, favor an overweight to equities, an overweight to credit instruments, and an overweight in private assets, including private lending and real estate, residential and commercial. That's a very risk-heavy portfolio. So how do you offset that? Of course, with some degree of interest rate sensitivity, high quality duration, as we call it. And since we believe that the top end of the yield range is probably near 2 or so, and we're probably now at the bottom, so we'd be underweight duration today, although it depends on what's in the portfolio. It's not very far when you're thinking about it mingling this duration component with other assets. It's a long way of saying we're still very strong believers in the 60-40 model, 60% stocks, 40% bonds, at least in terms of the risk factor profile. And so there's still a very good place for bonds, even if yields likely rise from here a little bit as we expect.
Well, Tony, okay, so 60-40 alive and well, but in order for that to really work, you have to have some assumption of the relationship between stocks and bonds.
Right.
Is that historic
Absolutely.
correlation between the two? Is that holding up, or is there strange dislocations that maybe is kind of toying with the 60-40 portfolio?
Well, it is. And if you look at various episodes this year, including the Fed's so-called hawkish tilt, which there's been a step back from about 6 weeks ago, these various episodes of risk off, where riskier assets did not fare well, high quality assets did. There is a question about the extent to which they'd fare well and which part of the yield curve would fare well. More likely, in our view, it would be in a very risk-off scenario. Of course, the longer maturities would see yields fall because the shorter maturities have a floor underneath them set by the Federal Reserve, which is determined, obviously, to prevent yields from falling beneath 0%. So you're right to be thinking about that construct. One can't be sure about the correlation, but highly probable that bonds would fare well if things get dicey.
Let me take the equity side of it. You talked about a high quality duration. Does that include tech stocks?
Well, a tech stock would be, of course, and most stocks in general could have very long duration. You could say it could be 30 years, 40 years. Tech stocks we favor, by the way, in our asset allocation profile and portfolio. We believe the semiconductor industry, for example, will benefit from the worldwide effort to decarbonize. Think of all the EV charging stations that the United States is looking to install. And the same for Europe, about 500,000 of them. All of those require chips. And so the various parts of the tech sector that look pretty good, but we wouldn't say that they're ways to balance a portfolio because they'd be highly volatile. And so want us to be thinking of the risk-adjusted potential returns there, although we would have an overweight in that area.
Tony, you'll have to forgive me for jumping around because if Alex is going to talk about equities, we've already hit bonds. I got to go to commodities next, and specifically gold. I mean, the opportunity cost of gold is pretty low, but it still isn't really breaking out. I mean, what do you do with it? Will there be a catalyst to help fuel the precious metal higher?
The way to judge it, of course, is against, various things. It's certainly whether there's a commodity cycle or not, we'd say no. Whether or not there's going to be further acceleration in inflation, whether or not there'll be continued worries about fiat currencies, and that's part of the Bitcoin story. It may be the case, but we believe the commodity cycle won't get in high gear, in part because we believe that oil prices will not help the story. Because in order to have a meaningful commodity cycle, meaning an upswing, typically there need be a meaningful move in the price of oil, which we think won't occur for various reasons, one of those being the likelihood that new supply would hit the market. And the same could be said about food prices, which had soared this year. Farmers tend to find a way to find new land to put crops in, and prices eventually simmer down. So the commodity story, we think, while supported by the global economic story, won't be underpinned from the energy side of the equation.
Can I infer then, first of all, I love the jumping around because we get all the different asset classes. Can I infer then that you
Sure,
think that
Alex.
the transitory...
You're in charge.
That's not at all true. That inflation is transitory and that it will settle down over time, or are there parts that are going to be a lot more sticky than maybe we're expecting?
Let's use a different word than transitory. Let's try to be
Please.
creative. I've written 6 books, so I try to find words. I'll use a thesaurus. And I'll use the word that kind of matches my name, a crescendo. There's a crescendo, a peaking of sorts, but it doesn't mean that, and if you're listening to a band, it doesn't mean it gets quiet all of a sudden. Transitory could infer that it's going to pass completely. But we would expect the inflation rate to stay elevated into next year, but then, yes, simmer down. We think by the end of next year, the U.S. Consumer Price Index will be in the low 2s. This is another way of saying the Fed will be failing in its goal to push the inflation rate, the PCE that was released today, the Personal Consumption Expenditures Deflator, above 2% for some time. And that will make it difficult for the Fed to remove its monetary accommodation. And as we started with the conversation, Alex, I'll do what we've been doing throughout the conversation here, go back to something we talked about earlier in the budget. Think of spending next year. The U.S. spending level this year, according to the Congressional Budget Office, would be $6.8 trillion. Next year, about 5.5, a meaningful deceleration in spending. I bring that up to suggest that the Federal Reserve will be looked at to help to offset that negative fiscal impulse. It'll make it difficult to reduce its monetary accommodation meaningfully. And so it's one thing that will underpin the bond market for some time. The expected short rate will be low.